Hey, good morning, guys. Welcome to the Truth About Real Estate podcast. Today we have Frank Furman, who is a Chief Operating Officer at PadSplit, a co-living startup dedicated to solving affordable housing crisis. Frank is disrupting the affordable housing industry by creating safe, attractive, and respectable co-living environments. A former infantry officer in the U.S. Marine Corps, thanks for that. He commanded at the platoon and company levels and served in 2 tours in Afghanistan. Welcome to the show, Frank. Glad to have you here, and thanks for serving too.
Thank you for having me. Appreciate it.
Yeah, so I want to get to know more. You guys are a co-living company, PadSplit. Wanted to talk to you more about the real estate side, the investing side, co-living, and how everything works. But before we get started on that, how did you get started in real estate, anyways?
So the old-fashioned way, by kind of stumbling into it. I have two co-founders in this business. One, Atticus LeBlanc, who's our CEO, and John O'Brien, who's our CTO. But Atticus is my brother-in-law, so I've known him for a long time. He's kind of always been in the real estate industry as long as he's been working. I've known him for as long as I've known my wife, essentially. And so he got his start in Atlanta. He graduated from Yale, moved here, was kind of working through a few companies, and was a commercial broker. And after, really kind of in the crash, that business went under. But he's looking around, he's young, and he's seeing all these properties selling for $20,000. It's like, maybe I should be buying some properties.
That's pretty cheap.
Yeah. Spoiler alert. That was a good decision and good timing. So, he'd really been operating on his own since then. He had a partner and so on. And I'd been aware of what he was doing. I'd invested in a few deals. Still am invested in some deals with him and his kind of previous businesses. But I was out and about. I moved a bunch of times. I was living in California. I'd moved to DC, and he was moving in the Marine Corps. So I was kind of aware of what he was doing. But he bought a house in 2009 in Southwest Atlanta. And, it wasn't the sexiest house in the world. It was kind of, cut up funny and so on, but it was selling for cheap. And that's the business he was in. So he buys it, and the two neighbors come by and they say, hey, we want to rent rooms in your rooming house. And he's like, I don't know what you're talking about. This is a rental. I'm going to put it on that, rent out through the housing authority. And they're like, well, we'll pay you $100 a week each. And he's looking at it. He's got 4 bedrooms. And he's like, okay, I get $800 from the housing authority, 4 bedrooms, 100 a week. It's like, okay, we'll give it a try. So he did it and did another one in 2012. And during this time, he built up this successful, real estate business with, 100 homes and 550 apartments. But the idea was always kind of kicking around in the back of his head. And, it was more labor intensive and took the right kind of asset. But what he noticed over that time was that it was more profitable, and significantly so. So, I've known him. I was seeing him all the time. I actually moved to Atlanta 5 years ago, so I was local. But I'd been in management consulting. I'd been in the Marine Corps. And then, I was kind of working a job where I had a lot of free time, and I was kind of bored. And he'd more or less gotten to the point with his businesses that he'd handed off a lot of the day-to-day to partners. We meet up and say, hey, this idea has just been, it's been on my mind. It's been a thorn in my side for years and years. This idea of shared housing, this solution for workforce housing that in some ways happens in every market. It's out there. When I was in grad school, I rented a room from a guy. When I was a busboy working as a teenager, all the kitchen staff lived in a rooming house. So it's something that's in every major metro area, but no one's really done it to scale, especially for workforce. So we kind of thought, hey, what would this take? How would you do it? And so we kind of got started there. And that was several years ago now. But yeah, I kind of made that transition like a lot of people, starting as sort of a passive investor who's broadly interested. And in some ways, my first real estate deal was a missed one. I'd moved to California, and at the time, this was kind of 2009, and the houses are super cheap. This is 29 Palms, so a cheap part of California, to be sure, a big Marine Corps base there. But I'm looking around like, I should really buy a house here because I'm going to be here for 4 years. I'll have roommates the whole time. I'll easily clear my mortgage. It'll be no big deal. And, the rent to purchase price ratio was just really skewed. Rents hadn't dropped, but, you could buy a house there for $100,000. And I ended up balking because the houses were in tough shape, and I was probably being too much of a cheapskate and thinking, I'm going to be busy, I'm going to be working. I could have bought easily for 110, but I really wanted to buy for like 90. I kind of made that mistake that a lot of people make, where you think, okay, 110's good. What if I pay 80%? It'll be fine. It's like, no, actually you get 80% of what you're looking at. So I didn't do it, and I end up renting there. And you look back on it now and you think, man, I really whiffed. I should have bought. It would have cooked. The houses that I was looking at are all worth 3 times that now. And so, given the opportunity a couple of years ago to kind of come in, you know, all in on the operating side, I decided to take the plunge.
That's a good option. You're learning from family and friends. You're learning that's part of it, and then even in the beginning, everyone does. The first one's always the hardest, and going from taking 100K property, which is nowadays is super cheap, and you realize like, why didn't I do it? And it's just a part of being scared to do it because like the financial risk, but at the same time, the numbers always make sense. But then people's hesitancy to pull the trigger is because the liability, the risk, what happens, what if, right? But what if you didn't do it? Here's what happened, and all of us see that like, oh man, I should have done that, because really after realizing, hey, real estate's a long-term asset and you're getting rental income, your house hacking it because you're living there and you're getting some supplemental rental income, which paying down your mortgage anyways, and the house is most likely not going to drop like crazy. Even at 100K, how much could it go for? 20K? Not really, right? You can't even buy that. You can't even buy a bathroom for 20K right now in my area. It's crazy how it is. And even if you look over the decades, housing just keeps going up and up and up. Even if there's downturns, it's going to go up again, right? It's just a matter of time. And if you have people helping, especially with rental income, paying down that mortgage, that's a big substantial value add, right?
Exactly. Yeah. So I missed on that one, but try not to miss on too many now.
Yeah, and even nowadays, I think people still miss on some, but now you see it from your experience too. You go, that's actually a good deal. Like, make sure we double check. Like, don't take that risk of missing when you realize, hey, that's makes sense. Financially, it makes sense for the team, for the group, for company.
Yeah.
So you're going from for example, going from applied physics, going from aeronautical engineering and U.S. Marine Corps, and jumping into real estate. That's a big change, right? Most people say, why would you do that? You're at a great point in career. Why would you change to real estate investing? That's risky.
Yeah, there's risk in everything, that's for sure. And I'd worked in R&D. That's my last posting in the Marine Corps, was managing a portfolio of R&D programs, alternative energy generation, kind of microgrids and that sort of side of things. And I did like it a lot, but to be honest, it was slow moving, and some of that was just kind of the nature of kind of working in government funded kind of research at that point. But it was always kind of for me, I've always been interested in a lot of things. When I look at it's part of actually why I enjoyed management consulting, was kind of different problems all the time. You kind of change it up. So I have a little bit of wanderlust, so I like kind of I find all sort of business problems interesting, whether it's anything, even if it's a unsexy topic like waste management or something, you still kind of find what's interesting, which is what are your value drivers? How do you think about costs? How do you think about fixed versus variable? And how do you kind of operate more efficiently? So it's less always around like the technology for me, or kind of any being specific. I'm interested by a lot of things.
Nice. It's funny. And actually, one thing too, like, I actually used to work with the Marine Corps for like 8+ years. I did PKI, network encryption security, and like trained the engineers in cybersecurity for many years. And that was fun because there's so many great guys out there, and a lot of them do real estate, do other side hustles, and then they support the government in the country, right? So it's kind of nice to see that too. A lot of friends that over there too. So I wanted to ask you too, like, for example, like, you guys started learning about co-living, I would say by accident, but at the same time because people started asking about the availability and the numbers made sense. But even when you first started doing that in your partners, like there's like multi-unit single family homes, fix and flips, there's other ways, but I don't see most people jumping into co-living and actually creating a co-living company based off of it.
Yeah. And so that's true. Maybe there's good and bad to it. It makes it defensible for us. I think there's a few reasons for that. One is it's a little bit outside many investors' experience, particularly the part that we do, in that we're a venture-backed tech company at our core, we're a marketplace company, and it's funny, you talk to investors and they say, oh, I get it. I get it. And they're like, but I don't know if I would live in this kind of setting, and you think, well, of course not. You're a decamillionaire, venture capital investor. Of course you're not going to rent a room. You have your own house. So there's an element of and you see it in all sorts of investors. You know what you know, and you know what you know based on your experience. So considering that most real estate investors have some means, enough to invest in a property, the concept of real workforce housing oftentimes is a little bit of an intellectual stretch, so that takes up part of the market. And the other piece that is interesting is there's a lot of culturally, we've kind of gotten away from the idea of co-living and sharing space. And a lot of people, they talk to me and they say, oh, Frank, this is interesting. I bet my kids would understand it. As kids, they share stuff and whatever. And I'm like, no, who would understand is your grandmother, because this was the norm for singles in the United States, and really is essentially anywhere, that single working adults boarded. They rented rooms because everyone shares space. I mean, I have 6 people in my house. It's not because I'm crazy. It's because I have a family. But I share a bathroom. But everyone shares bathrooms in my house. It's the way it works. So this kind of cultural concept of, hey, I'm a person. I've got my own space. I've got my own kitchen. I've got my own bathroom, and so on is actually pretty new. And perhaps not totally sustainable. As you can see, there's lots of people who can't afford kind of that base, studio apartment and so on. So really, it's a matter of kind of getting back to our roots on that front, and kind of reintroducing this concept, which we did not invent. It's been around for years and years and years. We want to make it better. We want to harness technology in a way that no one's done previously, and be cutting edge on that front. But it's really kind of reintroducing it to people who it's been outside of their experience. And then the other piece of it is, there's a lot of, in part due to the lack of understanding or familiarity with the concept, there's a lot of concern around, oh, this must be a real pain to operate. I'll give you an example. I get asked all the time, Frank, this is super interesting, but strangers living together, I mean, there's got to be a million fights, all this stuff. And you look at it and you say, look, I've been a landlord. Husbands and wives fight. Boyfriends and girlfriends fight. Brothers roughhouse and fight because they know each other. You really only fight with people you know. That's the reality of it. Strangers may be passive aggressive. They may complain. They may be petty. All those things are true. They may eat the last slice of pizza that someone left in the fridge. They're not always best friends, but they rarely fight because they don't care that much. People want privacy. So, this concern that people have, oh, I'm going to be a landlord. I'm going to be running this property, and people are going to be fighting all the time. It's like, no, actually, you should worry about that in your normal rentals, because families fight, strangers avoid each other, So, and then that's part of the problem that we've been trying to solve through kind of operations and technology. So, we staff a 24/7 call center. All of the resident dispute issues come to us. So, oh, Matthew ate my peanut butter, or, oh, Matthew looked at me funny. Those things come to us, and our team is trained to de-escalate those conflicts, whether through our rating system or allowing transfers. So building in that kind of flexibility so that you can have a release valve and manage those conflicts, because they do arise. Some people are tough to live with. We've all had roommates. It's part of life. So, how do we improve technology and improve kind of the underwriting to kind of get there? But yeah, really, there's the big barrier for us is a lot of people aren't familiar with it. They aren't ready, and they have some misconceptions. So part of our job is education. Part of it's kind of solving those problems for people. And then oftentimes once they get it up and running, they say, okay, well, this isn't that far. And, oh, this isn't that different from when I was in student housing or what have you, or from the Golden Girls. This is, it's not that far in a concept when you get down to it.
Nice. That actually makes sense too, because when you think about, like, for many of us who went to college, you probably lived in a dorm for at least your first year, and you met random people, right? And you stayed together and you shared things together, and, like, you actually build relationships that way too, and hopefully mostly good. Sometimes people get some bad, but the ability to switch makes it a lot easier too, even though you're moving in and out. And yeah, I think, as we get older, we realize, hey, okay, yeah, we actually done it a lot. And I see nowadays, even in San Francisco, the Bay Area, a lot of people do get together and they, say, hey, instead of getting a studio for the X amount, why don't we get a 2-bedroom, 3-bedroom, 4-bedroom, 7-bedroom and split the
Yep.
cost, because it makes more sense, because now you get a way nicer, way bigger space, more utilization. You build your own community, you form relationships with people who are kind of like-minded, like active,
Mhm.
people who are really active, people who are really tech savvy, people who are fashionable. People get together and they start forming new friends. That's the fun part. I think when you're young and single, you can definitely do that. And
Mhm.
even you mentioned too, as you know, have singles in even at an older age, they want company. You don't always
Yeah.
want to be alone in your house, especially nowadays with pandemic. It's nice to have like your own little sphere, and then
Yeah.
be in that group and have friends, and pay a lower rent, and less work. But yeah, like, even friends will eat your pizza, right? It doesn't matter.
Yeah.
It'll come about.
Yeah, exactly. And I mean, the thing for me, and part of why I'm really passionate about the business is, this is something that I've always done. I rented a house and rented out rooms to my buddies. I share space now. This is how everyone drives down their cost of living on a per person basis. It's what, normal people do. That being said, when I did it when I was in grad school, in the Marine Corps, whatever, college, um, when you are coming at it with high level of social credibility, high level of social network, it's pretty easy, right? If I moved to San Francisco tomorrow, well, I don't know who would want me to move in with my 3 children and wife and so on, but let's assume I'm a single guy, or whatever. um, People say, oh, went to college, okay, here's a resume, we feel comfortable, so on and so forth. um, we serve the workforce, right? We serve people who are not making as much money, who struggle to afford rent. They're probably the people who the most need these tools, who most need to share space. Yet, if you didn't go to college, if you don't have kind of the resume, you're working in kind of a, hospitality or food service or as a security guard, it's a little bit harder to roll into a new city for work and say, hey, I don't have much of a resume. Maybe I don't have the same level of technical fluency and so on, technical ability. Uh, who wants to meet a room? It's harder. And, the barriers to entry are so high in housing, where if you look at, in particular, Class C apartments, you know, I may be able to get away with 1 month's security deposit and just 1 month's rent up front. But in the low income space, it's oftentimes first and last month's rent or double security deposit. So the barriers are even higher. Um, and there's reasons for that. Credit scores, we can all get into. We all have to do our own underwriting, but the barriers are higher. So our mission is, how do we bring those same tools that are not revolutionary? They're not from a different world. They're things that we've all done, but they're easier for me to do than for a lot of people. And so, how do you kind of democratize it? How do you bring it to everybody?
And that makes sense. And I'm actually glad that you guys are, like, for example, you're helping with workforce housing, which is
Mhm.
really needed. And like you mentioned too, there's, people all different industries, job, different pay gaps, and, the ability to afford it too. And there's a lot of singles out there, and even couples, but to get in a nice place, to get closer to, more convenient, it is harder, because, landlords do scrutinize based on credit scores first, and,
Sure.
financials, and it makes sense. And I get it, because landlord has liabilities too. But now you're giving them the options to say, hey, you can make more money. You're actually reducing your risk. Here's how we do it as a company, and here's how we help you vet the people out and make sure they try to create some more leverage on that and reduce your risk. And then
Hmm.
owners start like opening up and say, oh yeah, that makes sense. I see why. Like, if I'm getting X amount traditionally, you're going to give me X amount and help me reduce my risk from turnover, from liability. Then why not take a chance? Now they need the understanding of, okay, I'll take a chance. How does co-living work? How do I work with you, the tenants? How does everything get resolved? So that's more the educational piece on how to help investors, and also how to help renters do this. But
Hmm.
financially, the model makes total sense. It's more about, okay, comfort. Comfort comes with education, right?
Right. Yeah, absolutely. And I mean, our view, you know, the numbers do make sense, and everyone kind of gets it at sort of a high level. It's not all that complicated, of course. Okay, if I've got a big house, I'm renting by the room, I make more, so on and so forth. But our growth engine is investor outcomes. So that's what we're hyper focused on. And when investors get a good outcome, right, they generate a above market yield. They do what all people do, and they brag about it. And they tell their friends, and then they do more of it, right? So they're people respond to incentives. So for us, it's all about how do we really kind of get involved to not guarantee, because that's impossible, but encourage those outcomes as much as possible. And when that's happening, our conviction is that the reason that affordable housing is so tight is that there's not a ton of financial incentive for developers and so on. So our view is, if you can make it worth the while, if you can deliver above market returns, well, then you don't really have a problem around affordable housing, because you're got to tap into the creativity and capital and intellectual effort of private investors who, when they're seeking yield, can be incredibly tenacious and dedicate a ton of resources to things. So for us, it's okay. How do you make it profitable? And if you do that, you can make it possible.
And why, like, in co-living spaces, like, even there's a lot of companies in the area, like, there's different models of co-living. Why specifically did you guys choose, like, workforce housing and even furnishing and creating all the utilities in one seamless transaction versus others who say they'd split it so many different ways?
Sure. So the main reason we're focused on the workforce side of things is we just view that as the biggest opportunity in the market, both in terms of the number of people. So I mean, as an example, there's lots of more upmarket co-living companies. They cater to young, relatively well-to-do, successful people in San Francisco who are working and earning, probably a good living, but can't quite afford the super premium zip, right? But they want to be in the city. They want to be close to things. It's okay. They share space, and that's fine. It's probably a great business. It's not the one I'm in, but I'm rooting for them. Makes a lot of sense. And but our view is, however many people there are, and there's a bunch of them, there's far, far, far more people, just a much larger opportunity for people who are not doing so hot and earning, 90 grand a year, that are earning more like $35,000 a year, $30,000 a year. So, and the other piece of it is a lot of investors don't want to work in that space, other co-living companies and so on. It's easy in some ways to cater towards that kind of upmarket crowd. Whether it's in terms of underwriting or expectations and so on, it's harder to deal with the affordable. So our view is it's a big opportunity with a ton of defensibility. And then as far as how we structure the spaces and so on, our view is that one of the big challenges that you have in affordable housing generally, but really just workforce housing, is it's pretty complicated. And I'll give you an example. The furniture is a good one. A lot of people rent furniture in this demographic, and they pay really high interest rates and so on, and it's problematic. And if you look a lot of evictions in this country, what happens is, landlords are kind of lazy and they're landlord focused. And I say this as a landlord, but rent's due on the first. Why is it on the first? Because it's easy for accounting, it's easy for the lender. It's the system I do. Okay, fine. But it's not that easy for someone. People pay bills sequentially. So these rental furniture companies, they'll bill at the end of the month. Your cell phone bill will bill whenever. And, I get the bill for my furniture on the 25th. Well, I'm going to pay that because I don't want to lose my couch. I get my cell phone bill on the 28th. I'm going to pay that. I want to lose my cell phone. And then the rent bill comes on the 1st. I'm like, I don't have the money. Oops. Now that's a bad idea, but it is how people operate. So our view is, how do you make it as customer focused as possible? And so we bill weekly, and the idea is it's tied to when people get paid. It's much more intuitive for people. You're kind of keeping on folks. So when's the first of the month? I'm not sure, but when's Friday? Well, I know when that is. That's when I get paid. That's when I get my bill. And by rolling everything up into one, utilities, furniture, one, you're driving your costs down. So people aren't renting furniture and paying, this kind of upfront costs and these high interest rates, it's built in. But also it makes it simple. So it's, hey, I've got one bill to pay. I can focus on paying that one bill. I'm not worried about, here's the furniture bill and here's this. Yeah, they still pay their cell phone bill, all well and good. But, I don't have to worry about the power bill and all that. And then the other piece is it just drives down your cost because, take your power bill. You may not have thought hard about it, but you probably have a, $150 deposit with the power company. Okay, that's fine. I have the same thing. I have Georgia Power here. I'm sure I have a deposit paid whenever I set it up in my house. Haven't thought about it, but I do it. Okay, fine. But I'm splitting it amongst a bunch of people and whatever. But if you're setting up your first place, you're doing that, and that's a pretty big bill. When you factor in security deposit, first month's rent, maybe first and last month's rent, and your security deposit for power and your security deposit for gas and so on. And it costs, really a couple $1,000 to get in. So how do you lower that barrier to entry and say, okay, well, the owner set up the power. Okay, it's paid. It's all getting rolled in. But, I'm coming in really with 1 week and a move-in fee, and it's just a couple $100. It's 10 times as easy to get people in the door. Furniture is already provided. You don't have to worry about lining that all up. So it's all about, how do you make it as customer-focused and customer-friendly as possible to get people in, and you want people to get in and start paying. That's how you make your yield.
And that's a great benefit because, for example, when you think about traditional rentals, like like you talked about, tenants gotta do all these things. They have to pay moving costs too. Sometimes when they move out, cleaning costs
Mhm.
out and moving costs out, and the time it takes them to buy furniture and just stage, like set it up for that space exactly. Because then each house is a little bit different. You're not going to use all your furniture. You might have to sell some, throw some away. So there's a lot of unfactored costs into moving, and just time and just stress, right? But
Exactly.
yeah, even the utility part of it too. I guess one question I would ask about the utility is, the landlord would set it up, pay all the deposits, set everything up. If you guys are charging weekly fees or weekly rent, and it's including the utilities, who manages the utility bills, and like how do you get reimbursements for that? Because it
Great,
changes every month.
great question. So the idea is we work with landlords to build it into the pricing,
Okay.
and part of that is how you set up the space, and that's outside of the experience of a lot of landlords because they haven't been paying the utility bills, and that's also part of the reason why we have affordable housing challenges. Is that the kind of things that I do in my own house because I'm a cheapskate who pays the utility bills. So I'm trying to drive them down all the time, and I'm turning off all the lights, and putting in low flow shower heads, and yelling at my kids to cut their showers short and all that kind of thing. Uh, Typically isn't being done in a lot of rental properties, right? So because if you're the landlord, why do it? You're not paying the bill, and if you're the tenant, it's like, what am I going to make a capex investment in this property I don't own? Like that's not going to happen. So what we do is we're trying to align incentives. So the landlord is paying that bill. And so any way they can drive down those costs, that's money in their pocket. So, it's really hard to get people to take short showers. That's true. But it's really easy to install a Niagara 1.25 gallon per minute low flow shower head that is $9 on Amazon. So people should do that. And that's kind of part of our playbook as we work with landlords, you know, aerators in the sinks, low flow toilets, and there's a few big things you can do. Use a smart thermostat. You lock it with a pin. When you control the thermostat, you're controlling probably 60% of your electricity spend, and it makes a huge difference. So people will still be wasteful. People take too long in showers. People leave the lights on. All that's true. But if you control the big components, you can, again, it'll be variable, but you can make it variable at a level that you can live with and easily budget for. And some months you do a little bit better, some months you do a little bit worse. But the idea is you go through, and then of course there are mechanisms you can pass through costs if people have kind of damaged things or that. But the idea is to just to budget for it, same as you would do in short term rentals. In Airbnb, you're not, you're building in your utility costs into what you're pricing the rooms at. You aren't worried about, I'm trying to bake in $30 for this person for this weekend and so on.
Yeah, that makes sense too. And yeah, especially both ways, because I see a lot of landlords, they don't want to, add all the capex improvements. I'm like, you really should, because you think about it, even if you're like passing it on to tenants to pay all the utilities, the fact, if you can help them save money through like all means of electricity, water, and everything, it's better for them too, and they want to stay longer because they know they're like living in a house that's super energy efficient, water efficient, and then they're saving money that way. So they're willing to pay more too for the rental because they have less to deal with. But
Yeah,
of course, I get the other part too. Like if you included, hey, unlimited water, unlimited electricity, some people will abuse it. But when you add
sure.
in other factors saying, hey, if you pass this level, then you're going to take on the billing because, standard water level, just call it $100 a month, and you go spend $200 a month. Well, I'm going to rebill you for the 100 extra month if you're doing that, like abusively.
Yeah, yeah, exactly. So yeah,
So
it's
that's,
it's difficult, but yeah, you want to. A lot of it's really kind of controlling the space and kind of aligning those incentives.
nice. And then, from a landlord's perspective, when you start thinking about like, why would I choose as an option, for example, like, hey, I can just do traditional, I might do Airbnb if my county allows it, or,
Mhm.
co-living space. Like, how do you talk to landlords and educate them about the co-living opportunity?
Yeah. So the way that we think about it is people do it because of yield, right? And in terms of you're trying to do that cost benefit analysis both for yourself and then also for the asset. So um, for certain kind of assets, you're best off. Your highest and best use is doing traditional rental, right? And others, maybe a short-term rental. For others, it's us. So we like kind of bigger properties, more bedrooms. And one of our initial insights was, for the right kind of property, it's much more profitable, but not for everything. So we like a lot of bedrooms, that kind of thing. It's more revenue generating units for us. And then same thing on the cost benefit analysis on your time and level of effort. I mean, obviously most people are farming this out to property managers, but we're a lot less work than a short-term rental, right? Because it's long-term tenants. People are there about 10 months on average. So, you're not doing these kind of weekly cleans and turns, and it's a different kind of level of service than a short-term rental, but it's more than a traditional rental. You have more turnover, you have more work. So it's kind of in the middle there somewhere. Um, but I mean, our view is, the numbers have to make sense for landlords to do it, and it's about having the right kind of host, the right kind of asset, and so to do that, we talked earlier about how involved we get to generate those outcomes, which is our growth lever. But I mean, we get involved early, oftentimes pre-acquisition. Every day I'm talking to investors and they're saying, hey, what do you think about 123 Main Street? And I'll say, it's on a cul-de-sac. It's too tight on the street parking. Don't love it for this. Or, oh, I really like it. It's a corner lot, or it's close to public transit, or, that many bedrooms at this price. I really feel good about it. And so, because we want good outcomes. So we're oftentimes getting really involved at that point. We have an ecosystem of preferred vendors who do a lot of the work, right? They're buying in this buy box. They're, general contractors who know how to kind of optimize the property the way that we've kind of trained people, and managers, the whole bit, lenders. So, building out that ecosystem is really important to make it easy for people. But, that's kind of on us to do. But yeah, people do this because they make a lot more money. That's kind of the bottom line. As I work with investors, looking at properties, I tell them, you should probably be looking to get about a 10% unlevered return on cost, which is really about double you can do in traditional rentals. And if you're not doubling, you're probably doing something wrong. It's the wrong kind of asset. You're paying the wrong amount, that kind of thing. And then obviously once you lever up, you can do a lot better from there. So it's about finding the right fit on that front, but it essentially works in any metro area, or close to any sort of employment center. So yeah, it's pretty broad brush, but it's for the right kind of asset, right kind of investor.
Nice. Let's talk about the numbers actually too, because I'm really
Yeah.
interested too, because I study a lot of different methods and different styles of housing and investing. But like, for example, just for even your markets or even in any market, like how do you run the numbers of traditional Airbnb and co-living, and like what do you see in terms of numbers for the investor side?
Sure. So, and we have an earnings calculator on our website that automates a lot of this. So again, I am a former Marine, so making me do math in public is a little bit, I don't know how I feel about that, Matthew. But the way I think about it is, you look at a traditional rental. Maybe it's a 4.2, and that's, you're beginning to get to the side. Maybe it's 1,800 square feet or something. So bigger property. Maybe it's in a transition neighborhood and so on. So you look at it, and part of our playbook is, okay, how do you capture and monetize underutilized space? So maybe it has a basement that can be finished out, or a living room or dining room, or some combination of turn into bedrooms. So, we look at it through that lens and say, hey, this 4.2 could easily be a 6.2, right? And we, okay, fine. Now maybe it rents for $1,700 traditionally, right? Because it's again, not in San Francisco clearly, but in Atlanta or Houston or Richmond or New Orleans or Jacksonville or Tampa, Indianapolis, one of the markets we're in. So kind of solid working class traditional rental, and you'd be doing fine, right? If you did as a traditional 4.2, rent out for $1,700, you pay your property manager maybe 10%, pay some maintenance each month, and so you're clearing maybe just shy of $1,500, right, on a month before your note. That's pretty good. You're doing fine. Maybe you're kind of all in on that property for say just over $200,000, right, in these kind of markets. So okay, hey, that's a pretty good return. That's maybe 5-6%. You're feeling pretty good about that. That's a solid return for a traditional rental. You get debt on it, feel pretty good. Your debt service coverage ratio will be okay, maybe just maybe a 1.3. You feel pretty good about it. Well, we look at that house and we say, well, it's a 6.2 in our book, and your rooms are probably going to be about more like 650, or at least certainly more than $600 a month, billed weekly. So all of a sudden, your gross revenue goes from $1,700 to say, $3,800, right? And okay, you're gonna have some churn. People are there, for 10 months on average, but your occupancy tends to be about the same, right? So a traditional rental, you rent it out, 2 years, and then it's time to turn it. You turn it, and you spend a month fixing up the property and turning. You spend a month leasing it up. It's okay. That's about 8% vacancy over the course of 2 years and 2 months. Well, our average stay is about 10 months. Takes us about a week or two to refill a room. Well, you still get to not over 90% occupancy, right? So, and your turn costs are lower because instead of turning the whole unit, you're just turning a room, and room turns really cost 50 to $100, right? You're changing the mattress cover, so your turn costs are a little bit lower over time, or a fair amount lower over time. But again, your gross rent, call it, let's say you're $3,600 monthly net of vacancy and collections risk, that sort of thing. Okay, fine. Well, you're more than double the gross rent. Like that's the big secret, right? That, from there the math gets pretty simple. So okay, you're more than double the gross rent. You pay PadSplit because I have kids. You gotta pay your fee to PadSplit. We charge a percentage of the revenue. You're paying your property manager maybe a bit more. Maybe they're taking 10%, but of a bigger number, so they're super happy because they're making $300 a month, and they're as happy as can be. You're paying utilities. That's a couple $100, but you're probably clearing, call it $2,500 a month. And you look at that and you say, well, I was doing $1,500 before, just shy of $1,500. Now I'm doing $2,500. The mortgage is going to be the same, your debt's going to be the same, your property taxes are the same, all that's the same. And well, that's an extra $1,000 every month in my pocket, essentially for free, for a fully loaded kind of turnkey kind of service. So that's the magic. It's not that people love working with me, or I'm so enjoyable that people want to talk to me to bring on more properties. It's because they make more money, right? It's a yield generating instrument. So they look at that and say, okay, great, I'm making an extra $1,000 a month. Now all of a sudden, instead of that 6% return, I'm at a 9, or 10, and I'm then I lever up and I'm at a 30% return, and that's while you're owning this real asset that is going to appreciate in value over time.
And those are some great numbers too. Like when I look at that and hear that, and I see the numbers, and I realize it too. And that's definitely becomes also more passive too, because for example, I have extra protection in my opinion, because for example, you have property managers already managing property, and then you have your company too. And then landlords are going to ask you some questions, which I'm going to ask you next. But looking at the numbers, if you're going to generate me $1,000 more per month, and it's not guaranteed, but when you look at historical ratings, that makes sense. Like then why don't landlords take more risks, think about more co-living, and getting educated to really consider it as an option, because it's a different kind of option, but financially it makes a lot of sense, and it's worth the opportunity to actually look into it deeper and say, hey, this makes sense for my market, for my property, and start doing that. But as an investor landlord, a couple questions that come up in my mind that people ask me is like, okay, well, one is like, does PadSplit or even other co-living have a master's insurance? Are they taking a master lease on it and then they're subleasing it individually to these people? But it's a different terminology because it's in your master lease versus as the landlord side. The next thing comes up too would be like, okay, well, in San Francisco, there's all these rental restrictions rules, even co-living rules. How does that apply? And I'm sure most investors say, well, these are landlord-friendly states with more relaxed policies, so it makes more sense for those markets versus rental restriction markets.
Yeah. So on the first part, technically we are signing a master lease for every property. Part of the reason we do that is to make it easier for insurance and lending and so on. It's a cash flow lease, so again, it's kind of that's the way that it works, and we are subletting, but it's we are signing that master lease. It's how it's structured. As far as the regulations piece, it's a really interesting question, and the answer is it really depends, because it's a hyper-local kind of regulatory regime. There are lots of places in the United States where this is gray area. There's lots of places where it is probably 100% illegal, and there's other places where it's really quite permissive, and you can kind of more or less do whatever you want within reason. Now, what I'd say with experience, what I tell every investor is, let's say you're in Atlanta, which has among the most permissive definitions of family in the country, which is, we're located here, which is why we got our start here, but it's a good market for in that regard. But then you cross over into East Point, Georgia, which is much more restrictive. Well, okay, code enforcement is not going door to door and counting toothbrushes. That's not how it works. It's even in a less landlord friendly state. That's not how it works. There's no SWAT team, counting and asking people who they're related to and doing blood tests. It isn't how it works. So you have less of a top-down challenge. What you have is bottom-up challenges, which is why part of the reason why we get very involved with investors, because certain, unlike a traditional rental where you can kind of do whatever you want, people will complain. HOAs may be really tricky, and some neighborhoods really don't like rentals. But there's a whole lot you can do. This is new, and it's workforce housing, and a lot of people don't like. Everyone likes affordable housing, but not in their neighborhood. It's kind of the rule of thumb. So you want to be very intentional about how you're being harmonious with the neighborhood and so on. So that's part of why we get involved, to say, look, what drives neighbor complaints? It's not, oh, there's 6 people sharing a house. There's 6 people sharing my house. No one cares. But my grass is always cut. My trash is always taken out, and so on and so forth. People care about cars. They care about parking on grass, or things that make the neighborhood look bad, right? So they care about noise, all those sorts of things. So as I work with investors, it's okay, as you look at this specific asset, it isn't just, oh, this is San Francisco versus, Oakland. It's, let's look at this house on this street, imagine it with 6 bedrooms tomorrow. What does that look like? Well, hey, we're 2 blocks from public transit. That means you won't need that many cars, which means, no one's going to park in front of someone's mailbox. Hey, it could be a really good fit on that basis. Or, oh, it's in an HOA. Are you self-selecting for neighbors who are going to really be all up in your business? If you have to paint your mailbox a certain color, are you just begging for people who are going to, dying to know what you're doing in the property? So it's much more about blocking and tackling and picking the right asset. And it means turning down business, right? So again, all the time, people say, I want to deal with this property. And I say, I don't think it's a great fit. I think you should wait for a better one, because this one you're asking for trouble, or, oh, this one's a very private lot and there's lots of parking, or it's parking on the back. And so that's why it's part of the reason why we're so involved with that, is to, it's not rocket science, but it's getting people and investors to see properties through this specific lens, through this slightly different use, right? Because you're going to have more stress on the parking and transit and so on. So how do you kind of work through that and set yourself up for success on that front? But in some places it's no risk, and there's always some risk, right? That's the nature of real estate. You can always have a neighbor across the street who doesn't like what you're doing, and if they complain enough, code enforcement will find a reason to give you a ticket. So how do you mitigate that risk as much as possible through these frameworks we've developed to give you the best shot to succeed?
Nice. And then how do you guys deal with insurance? And do you guys have, the company PadSplit has their own policy for the homeowners, and then on top of that, the landlord should have landlord protector policies, umbrella policies on top?
Yeah, so landlords have to have their own policy. We've got a network of providers who we work with who will write specific policies for this type of use. And in general, there isn't really that much different from traditional policies, right? The big risks to the property, hurricane or hailstorm or what have you, are the same. We get blamed for a lot, but controlling the weather, isn't really our fault. So that's about the same. We do have some mechanisms in place to help landlords with kind of unexpected costs that are due to the nature of the model, whether it's passing costs through to the members, the residents in the house, or we have a couple of mechanisms built in if there's issues with damage and so on. But it's mostly done through these partners that we've developed to provide the insurance.
Nice, yeah, because I know some insurance companies, you always have to double check, especially if you're doing different styles, a traditional rental versus co-living or Airbnb. Even then, you have to check to make sure that company allows it, but you have a network which allows it, which is great because now they feel more comfortable that way. The next question that would come up as an investor too would be, okay, well, how do you define the right clientele to rent the property, and how does that work with other roommates too to really create a cohesive space for them to live in together?
Yeah, so as far as how we find people, I mean, our marketing engine that we've developed is, nothing that you'd find too far. We do digital ads, print ads, that kind of thing. And we do the screening. So we do background check, credit check, income verification, employment verification, to kind of provide that base level of screening for the hosts. And finding people, the good news about our business is, I don't want to say it's easy and we have a great marketing team who does it and they do a great job, but turns out there's a lot of people who need affordable housing. So at the very least, it's a stocked pond. And then it's interesting, we get that question a lot as far as how do you, are you matchmaking, this kind of thing? And actually, we don't. It's first come, first serve. There's legal reasons for that around kind of fair housing law and so on, and also just the perception of kind of fair housing complaints and so on. We don't want to be seen as saying, oh, sorry, Matthew, you can't move in because if this is all women in this property, okay, can't do that. Like that's I would argue at least borderline. The other piece of it is you actually kind of want it to be random in a way. Like I think giving residents coming in power over what kind of house they're moving into and who's in so they can self-select is great. But, we've done a lot of research on this front. And if you speak to most universities today and you say, oh, how do you match people? They say, latest literature says you don't. You let it be random because if you and I are moving into the same house and I say, we're going to be roommates, I'm like, oh, good, because I'm messy and Matthew said he's clean, so this will be perfect. And it's like, we've been, there's this false sense of like, oh, this algorithm has placed us and it's all going to be great. And I've had expectations that the system worked. Well, actually, no one really knows the system that works. And you as a clean person may be really mad to be living with me as a messy person. So what universities do today almost to completely is to just randomly put people together and let people go in and say, hey, it's on me to make this work. There's no algorithm doing the work. It's on me as an adult and hey, there's a release valve. If you and I aren't getting along, I transfer, so on and so forth. It's not a forever, it's not a marriage, right? It's just a semester, what have you. But so yeah, now most universities actually don't do matching, to the extent that they do any of it, it's at a very, very high level. Most universities are co-ed now, in part because they've realized that men and women living together at least make the men live a little bit cleaner. So we do the same thing. It's first come, first served. And, our view is residents, they're adults. We should treat them like adults. And it's, we're not arranging marriages. We're putting people in the same place. So they've got to work out issues on their own. We give them tools to do that, messaging tools and chore checklists and all those sorts of things to make it as easy as possible. But matching is really, really, really hard. And trusting adults to act like adults is actually a lot easier and more effective.
Nice. And other things come to mind too, is like, when you guys are like, they're getting to self-select, not self-select, but they're getting randomized. That's actually cool because, for example, let's say, you're a sports guy, you like sports, all these things. I'm a tech guy and I just want to be at home, but like I might open up and say, hey, I actually want to learn more about that and how to do that and become your friend and hang out and say, hey, can we go do that together and like, help each other? Or if opposite too, like you want to learn more about computer science, tech and everything else, you might ask me questions and become, connected to different people that you normally wouldn't have been connected to otherwise. And that's kind of cool too, the randomness of, meeting new friends in different spaces.
Mm-hmm. Yeah, no, exactly.
And I think another thing I think about too is, okay, one benefit too I see too as a renter, for example, if I get a single house and I want to rent with someone, I might go on Craigslist. That's harder because you really don't know them. And then the next challenge would be, hey, how's their credit? How's their financials? What happens if now I'm on a lease with someone else I don't really know, or even a friend you do know, you don't really know their financials, what their means are exactly, and what happens if they default on you? It's your name's on it too. But in the co-living space, it's different. I would assume it's different because you're individually liable to that part with PadSplit rather than the landlord itself. So then there's more comfortability in that sense. Okay, well, this roommate's bad. Hey, PadSplit, kick them out. They're not paying rent and they're messy and they're violating everything.
Exactly. And I mean, one of the things that's absolutely right. We decouple the commitment. So individuals are committed. You're not in it as a house, even if you're in it together as far as cleaning goes on. So that's definitely true. And the other piece is, we look at us as a vehicle for financial independence for folks. So we do, the demographic we serve oftentimes is unbanked, about 40% are unbanked. And oftentimes, even if they're banked, they're very thin file, right? They don't have much of a credit history. So we do credit reporting as a service to our residents. And the idea is, if you're making weekly payments, it's more than 4 a month, very quickly over the course of just a few months, you can really build your credit score, especially if you're thin file. So, 88% of our residents are improving their credit score, oftentimes by over 100 points. And, it's not only are you decoupled from what your, the other person in the house might do, but you have kind of this opportunity to get a ton of data points reported to bureaus very quickly, so you can kind of move up the housing continuum and, build your credit score to the point where you're, ready to get your own apartment and move up. Because our view is, co-living is a price play. People do it because they want to share, they want to save money, they want to, build their savings, but eventually people want their own space and they want privacy. So how do we kind of enable that journey for people?
Yeah, and I think about too some benefits especially for tenants too. With this
Mhm.
benefit is, when you think about the cost and everything now, and you look at PadSplit, like, hey, that's a new opportunity for me, and I can live in different spaces. I see this house is already furnished, ready to go. I can move in anytime, and you're helping me build my credit report. And I have a thin file, and paying weekly, and makes it easier too and less to manage. It seems less stressful and more beneficial to them. So like, it seems like you guys are trying to create a win-win situation for everyone while trying to reduce the liabilities for both side parties, which is pretty cool. And I think it's a different, newer method for investing in real estate.
Mhm.
How do we let more people know about the co-living space versus like Airbnb and versus traditional housing, and like how do we educate that side for them?
Yes, it's an interesting question. I mean, we talk to a lot of investor groups and have forums like this to reach out to people. Some of it's you learn by doing. That's definitely kind of part of it. And we've had people kind of get together to do a house. Landlord groups doing one as a team or through syndication, which is fine. But definitely takes conversation. We're involved on that front. We have some resources on our website. Get padsplit.com and kind of read some of the case studies and so on. Learn a little bit about the stories of the people in the houses and kind of what they're doing. But uh, some of it's just I think for a lot of people, just kind of taking that first step to say, it seems different and new, and co-living is a little bit of a buzzword, shared housing, and people think, oh, it's like a new asset class, and then you say, but you've done this before, right? And like, oh, yeah, actually I did, and yes. Oh, it's like student housing, but for people who aren't students. Like, oh, yeah, I kind of get how that works. And, we've got our own little quirks and so on. But it's, we've got some unique and proprietary technology for how we tackle the problem. But it's, the fundamental idea of like, oh, I'm living in a space with other people and we're sharing space, and so I can pay less money. Okay, yeah, I kind of get that. And you kind of get people to think about it in terms of their own experience. And it's sort of a pretty critical unlock a lot of times. Um, but yeah, always looking for people to talk to and spread the good word. That's for sure.
Nice. Yeah, I'm really interested in that model too. And looking at the numbers for myself is like, this makes sense for a lot of
Mhm.
myself and my clients, right? So we're kind of digging into that market. But at the same time, I want to ask you a couple questions before we wrap up too. Like,
Sure.
what do you think about the market in general right now? Like, just the real estate market. Do you think it's going up? It's going to crash? It's just slowly going to peak down? And like, how does that affect housing and rental market and even co-living?
Yeah. So we're affected by the same kind of macroeconomic factors as everyone else. So if U.S. real estate's up, I don't know, 20% year over year, that's affecting our investors who are now buying 20% more than they were last year. Um, I don't foresee a crash by any means. I think anyone who's in the market today, the last crash was too recent. A lot of the people who have resources today have resources because they did really well after the last crash. So it's just too new in people's minds. So that even if you had, I don't think we will continue to have appreciation at the pace we've had over the last couple of years. I think that's unsustainable. Um, and there's COVID reasons for that. And there's kind of inflation reasons for that we can talk to. But I think I don't think the rate of growth is sustainable. But I think in general, you might have a little bit of a slowdown. But I certainly am not worried about anything kind of catastrophic. I still think we're probably about 5 million homes short in the United States for what we really need from a housing supply standpoint. And it's still very tough to build homes, is the reality of it. I mean, you see a lot of policymakers, both at the state and federal levels and, local levels and so on. I mean, you actually look back, I was reading a policy document from HUD from the Reagan administration the other day that you look at is so fresh. Nothing's changed. This is, I think, 82 when it was published, and you look at it and you're like, yeah, local regulations and permitting and zoning really makes it hard to build new housing supply, and we need to liberate that. And you're like, okay, well, that was 40 years ago, and we're still saying the exact same thing. So it's a hard challenge, and I don't think that's going to get a whole lot easier. So yeah, I mean, there'll be more foreclosures. That'll loosen things up a bit. There's some new build starts. That'll loosen things up a bit. But even if there's a bit of a slowdown and a bit more supply on the market, I mean, right now inventory around here is maybe 6 weeks of inventory, whereas maybe 6 months is probably a healthy level. And I think that's broadly true in a lot of major metro areas today. I think that will grow, and there'll be a little bit of not necessarily downward pressure, but less upward pressure on prices. But yeah, it's tight. I sure wouldn't mind if it were shake a little inventory loose. That's for sure.
Yeah, I agree with you, and I think the number one thing is there's not enough housing. Period. The global economy, people are developing. There's more and more money out there, and the fact the population is just growing at a global scale, it's going to be really hard. And I see, even though there's dips, it's still going to keep going up. Like, you want to be in good cities, metropolitan areas, the price is not going to just drop suddenly. For what reason? Even if there's major foreclosures, there's still a lot of money out there at play, and the world's getting smarter. There's more money being involved, and people will move. So that's how I see it. One last question I want to ask you too, especially as a business entrepreneur, and your company has over 50 employees. How do you successfully scale your business from a startup to grow a real company? What's
I was going to ask you the same question. I have no idea. And scary enough, I think even just in the time, we're up over 100 people now. So we've certainly been growing like crazy, which even just hearing that come out of my mouth is a little bit kind of shocking. Thank you.
That's a lot of people to manage,
Yeah, no doubt about it. So it's, we're still trying to figure it out, but certainly part of it is just kind of, is getting the right people together from the start. Your kind of leaders and people you can trust to have good judgment and make decisions and so on. And, to some point, part of the reason I'm shocked that we have 100 people is when we started, I had to meet every single person, interview every single person. It was a ton of work. And now I'm like, who are these 10 people that this other person has brought on? You kind of have that same kind of exponential growth from that. And certainly, aligning around a vision. We are we're a company, we have a profit and loss statement, and, all those things. We do all the kind of boring stuff that every company does. But, for us, it's about always kind of harkening back to why we do what we do, both as a company and as individuals, because it's maybe a little different for me than it is for someone else. But, I have the reason that I kind of lean into it every morning. And the reason I'm leaning into it late at night, every night. So that's kind of really important. But, and then I guess the last piece is just, we've always had this idea that this was going to be a big thing. There was a time perhaps early on where we said, we're just starting out. We said, hey, is this going to be a niche play where we do a few houses and it's going to be a real estate investment? Hey, maybe that would have been fine. We probably would have been profitable already. Maybe we're doing okay. But, from the early days, we looked at it and said, look, we're building for scale. It's going to make it hard. It's going to be a dumpster fire every day in a lot of ways. We're going to lose a lot of money building things before we need it, and all that piece. But we've always seen this as, hey, this is a company that's going to be huge and is going to be everywhere. We're not a regional play and we're not a niche play. We wanted to build this thing into a monster, and to the point where it's, hey, this is something everyone's heard of, and there's an IPO and that whole bit. And even when it sounded insane, and it was just a couple of us looking around a table and we're the entire company. But we always kind of had in our minds that, this kind of deep conviction that, it was kind of win big or die trying, and not that we haven't made mistakes along the way, because we don't have enough time in this podcast to go through, things I'd like to do over. But I think that was what we got right from the start, was just kind of having this, it's a big problem and it needs a big, audacious solution. And it means kind of just shooting for it.
I agree. I think you guys are on the right track too. When I look, I've been in real estate for 14 years as an investor and as an agent and broker, right? And I see what you're doing. I think is really great, and especially targeting workforce housing, which is really much needed across the country. There needs to be way more housing, way easier, way more ability for tenants to get into the right places they want to live in. They should enjoy really nice spaces too, and be able to afford it and find the right solutions for them at a way which also helps the investors and create less liability. And this is one of them I see. I think in terms of like the businesses, like, when you came from the U.S. Marines, U.S. Marines has a really good mission statement, right? And they really ingrain it in you to really learn it. And when I talk to team leaders, I ask them, do you guys have a really good mission vision statement? Are you guys ingraining that to your people? Like Army, Navy, Marines do? No. Most people say no, right? Why not? Isn't that one thing they really believe in? And when you have the whole team believe in that one thing, they're going to do everything they can to make it really successful, right? So that's a really big thing for leadership to really like help instill and create the culture and the drive, because when you have the mission, nothing else will matter. You're just going to hit it, right?
Right. Yeah, I know exactly. Yeah, and I
Do you
guess
remember what the U.S. Marines mission statement is?
Well, so if you really want to go back to our 7 missions in the National Security Act of 1947, I could walk you through it. But yeah, it would bore the whole team. But yeah, and I mean, you're right. And I mean, the one thing is, or maybe there's a couple things in that it's about the actions, and I think one of the challenges that a lot of organizations have is when you get to a certain size, it's more about is it the appearances of doing the right thing, or is it about doing the right things? And it has to be about doing the right things. It's not about the spin. It's not about, the window dressing or whatever. People kind of get cynical and they say, hey, and I mean, in fairness, I saw this in the Marine Corps too, because it's still a big organization of, when I left, almost 200,000 people. It's a little bit smaller now, but, but the idea is to fight and win the nation's wars. Our business is in creating affordable housing. It's not about raising money. It's not about these tangential things. It's not about having a great press release or what have you. Success for us is people in rooms that they can afford. That is success. It is literal, tangible things. You got to do a million things to get there, and all these, you have to build the technical product, you have to do the marketing, and do your bookkeeping. All that stuff is real, but the idea is it's not about impressing people with hey, we're here to do this, we're here to do that. It's it's about housing units. It's about creating new ones. It's about attacking this crisis. It's not about appearances. So kind of having that same sort of singular drive, and also accepting the fact that it's a tough business, and you can't have a zero defect mindset, certainly, because it's the reality of being in low income housing business is you're going to deal with challenges, whether it's maintenance, whether it's residents who give you a tough time. Our residents are people with real problems, and they'll let you know about them sometimes. So it's you have to be tolerant of mistakes, and that are made with kind of the right intentions too.
Cool. I appreciate your feedback on that too. And really, I think we had a great conversation today and learned a lot about, co-living spaces and how to deal with it, and like workforce housing, which is, a really important factor. I appreciate you being on our show today. How do people reach out to you?
So I'm easy to find. I'm just Frank at PadSplit.com. So we're not too inventive on that front, but you can either reach out to me directly, or you can go right to our website, PadSplit.com, create an account. Our much more helpful and friendly sales team will be in touch very quickly if you do so. But yeah, feel free to reach out to me directly. Would love to kind of have the chat. And this is my calling. It's what I do every day. So yeah, always happy to talk PadSplit with anybody.
Cool. So, especially investors out there, you guys looking for to create other co-living spaces, look at investments, look at, out of state properties. It's kind of cool. Like, for example, if I wanted to buy a property, I might start talking to you, Frank, and say, hey, I want to buy this property in this area, and PadSplit is there. Let's run the numbers together. It makes sense. It's more than traditional short-term housing. Hey, let's consider buying this property,
Yeah, exactly.
Perfect. Everyone out there, be sure to check out our show, The Truth About Real Estate, on any Apple platform and other platforms, and we'll see you guys in the next one. Have a good day.